So let's finish the lecture on the stock market crash and just talk about specifically what happened the day the stock market crashed. And we talked about sort of the underlying weaknesses in the economy leading up to it. All these things came to a head, especially the debt crisis, when the Dow Jones average, which is the average price of stocks in a day, you'll see the Dow Jones average every day in the paper and on the news every night. When the Dow Jones average, or the average price of stock, plummeted. To give you, for instance, during Hoover's first year, it had gone from $191 on average per day to $381 on average per day. So everybody was making money in the stock market. But then, on Black Thursday, October 12th, 1928, stock prices began to fall. And when they began to fall, it created a sell-off where a lot of people began to sell stocks, which made all the stocks less valuable. GE started that day, the largest company in America, selling for $400 a share. By the end of the day, it was down to $283 a share, which is bad. Doesn't mean the stock market collapsed, but it means that the average price of stocks fell dramatically during Black Thursday. What that means is that on Black Tuesday of the following week, the bottom fell out, October 29th. Usually during a day, about 4 to 8 million shares are sold. And usually during the day, about 4 to 8 million shares are bought again. On Black Tuesday, a sell-off occurred again where people began to sell their stocks. And 16.4 million shares are sold, and there were not enough stocks to make up the buying of those stocks. So what happened was the stock market completely collapsed. $30 billion of investments, of money people put in the stock market, was lost in one day. And this was the beginning of the Great Depression. So, to give you an idea of how this works, in a simple cycle, investors will lose money. Lots of money. Businesses will lose profits. And if businesses lose profits, then investors will lose money, which means more businesses lose profits, and that is a vicious circle that doesn't end until the economy improves. The same can be said for businesses and workers. If people stop buying products, then businesses cannot invest in themselves because they aren't making as much money. Production will sometimes go down. Some businesses will fail, and that means that there are less people working in those businesses, that people are laid off. And if people are laid off, that means there are less people buying things, which means businesses cut, production falls, some businesses fail, more workers are laid off, and it's another vicious circle. Can be the same thing can be said for banks. Now follow me on this one. If someone takes a loan out from a bank and they lose their job, well, they cannot pay back that loan, which means that the bank no longer has as much money. Eventually, the banks will not get the money back that they loaned, and they'll run out of money, and they'll fail. If you had money in that bank, you've lost your money. Everybody wants their money back, so some people will get their money back, but if the bank runs out of money, you lost your money in that bank. Nothing was guaranteed, which means your savings account is gone, which means you may not be able to pay back the loan for the house or the car that you bought, which means you can't pay back the bank, which means more banks will run out of money, more banks will fail, more bank runs will occur, people wanting their money back, etc. And the last vicious cycle, we'll go over these one more time in class. The last vicious cycle is this. The world. Production in the United States fails. U.S. has very little money to invest in Europe. U.S. cannot help Germany as it tries to rebuild itself. German payments for reparations begin to go down. That means that Europeans cannot afford to buy U.S. goods that we're importing over there or exporting over there. And that means Europeans cannot pay the debts to the United States because we loaned them lots of money after World War I. And if they can't pay their debts, that means production in the United States falls because there's less money in the United States. Another vicious circle that we'll go over very quickly in class again. And that is the end of the entire lecture for Thursday and Friday.